Come to order at 7:30 in the morning on Wednesday, August 6th. This is the Retired Employees Healthcare Benefits Trust meeting. I am Treasurer Michael Shostak, and with me, as always, Trustee Chris Kolinsky and Finance Director Jason Tice. Let's stand for the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Okay, thank you. Moving on the agenda, now is the time for public comment. I'll open the floor for public comment. We'll limit your comments to 3 minutes. Seeing none, I'll close the floor for public comment and move forward with the agenda of the meeting. Next item is to approve the minutes of the May 7th, 2025 meeting. They were submitted to you in the packet. Any comments or motions?
I make a motion, we approve the minutes as submitted.
I'll second that.
Second that. Okay, all those in favor say aye.
Aye.
Opposed? Okay, that carries. Okay, moving on. Item 5, our quarterly portfolio review. We welcome from Mariner Institutional, Brian Green and Mike Hoycross to give us an update.
Good morning, all. As I've mentioned, you got to standing here at this podium and getting ready, not just for this presentation, but others, is like, what was the story of the quarter? And I would say, like, and it'll be the same comment for retiree healthcare as it is for DB, is very good news, but not great news. I guess it would be, if I'm going to temper your expectation, is not towards disappointment, but not as happy as I could have been, right? Because we saw significant gains in the capital markets in the second quarter of the calendar year. It is the first quarter of the Township's fiscal year. So it's one of those scenarios where a number of strategies, just given the magnitude of the gains we saw in the quarter, struggled to keep pace. So it's a function of, we made you money, we just didn't make you as much money as we potentially could have. So if you jump into the book to page 4, overall market commentary, for the quarter, the S&P was up 10.9%. That now brings it into positive territory so far, halfway through the calendar year, where it's up 6.2% for the year, a little bit higher today. Small and mid-cap stocks both collectively up 8.5%. That's brought mid-cap stocks now just barely into positive territory, but small-cap stocks so far for the year are still actually in negative territory. It's kind of that reminder of just how difficult the first quarter was, just around rates, tariffs, economic news, Iran, you name it. You can kind of spin the wheel of what's my stressor today from a global economic standpoint, and it would change on a day-to-day basis. The real story is continued growth from an international equity standpoint. There's always that debate of U.S. versus international from a stock investment standpoint, and the U.S., frankly, has held that title on a calendar year basis for 10 plus years. With tariffs, with economic growth slowing, not declining, but growth slowing, right? Kind of like the same story as inflation. Like, inflation has slowed. Does that mean the things that got really expensive are less expensive? No, it just means the things that got really expensive are getting more expensive at a slower pace, right? There's a distinction there. We're still growing, just not as quickly as we were before. But as I mentioned, the real story so far for the year has been both developed and international markets. So as an example, the MSCI EFA, which would be Europe, Australia, and Japan, was up 11 and change for the quarter and is up 19.5% so far for the year. And emerging market stocks are up 12% for the quarter and up a little over 15% so far for the year. Fixed income, less of an issue, obviously, when we talk to the DB portfolio, but a little bit of exposure here in retiree healthcare. Continued positive moves is kind of the longer end of the rate curve, which is more a predictor, right, seeks to predict future events. Right, the Fed could cut rates today by 100 basis points, and that's not necessarily have any bearing on the 10-year or 20-year or 30-year Treasury. But longer-term interest rates coming down a little bit during the quarter, that's the bond market saying, I know the Fed said we're not going to cut, but you're going to cut. And you're going to cut sooner, you're going to cut more aggressively than you maybe think you are. So how did all of that impact things from a retiree healthcare trust standpoint? So jumping to page 6. So as I'd mentioned, don't be disappointed, just don't be as happy as maybe you could have been. I feel like that's a conversation I have with my kids on a daily basis. So overall retiree healthcare trust so far for the quarter up 6.15%, lagged the policy index that was up 775, really because of two strategies, Clarkston and Reinhardt. What's funny is, for a number of these strategies, what hurt in the first quarter worked in the second quarter. So in Encora's case, two of their largest holdings are Broadcom and Microsoft. Those two hurt in Q1. Those two are the single biggest driver of their outperformance in the second quarter. So as a number of these names coming in and out of favor, based on headline news, that's been driving, particularly for some of the larger cap names. Fidelity S&P 500, no surprise, 10.94, right in line with the S&P 500. Clarkston, significant underperformance, down 3% versus the benchmark up 8.6. Can we touch on that last? Can we end with that one? Reinhardt underperformed for the quarter, up 5 versus their benchmark up 8 and change. Two things going on for them. The first, it will be what they didn't own, notably Carvana and Robinhood. Those two stocks collectively for the quarter those two stocks collectively so far for the calendar year for small and mid caps basically flat. Those two names are 2% of the benchmark performance. Robinhood obviously more focused on crypto and fractional shares, right? If you want to buy $10 worth of Disney for your child, you can do it on Robinhood. And Carvana, which if you're, a car aficionado or anything like that, it's a great place to sell a used car that you don't want to sell to somebody that you know, but isn't always viewed as maybe the best because quality control and a number of issues. So that stock has been crushed and rallied and crushed and rallied. And frankly, is something that if Reinhardt came out and said, hey, we outperformed this quarter because we owned Robinhood and Carvana, that would be a difficult conversation around. You're going to need to justify owning those names based on what you've said your process is. The other would be that same story of what helped in Q1, hurt in Q2, and that's notably Lantheus and Insperity, which are like an outsourced diagnostic and an outsourced HR company. Fidelity Extended Market Index Fund, the single best performer, up 12%, right in line. Obviously, largest names in that benchmark are going to be things like Carvana and Robinhood and Snowflake and Roblox, all names that have been in the news, all stocks that have rallied significantly, but have difficult balance sheets and aren't something that you would see in a Clarkston or a Reinhardt portfolio. But this is why we have our small cap allocation balanced between a couple of active, higher quality focused managers paired with an index fund that owns everything. So when the stock market is saying, we don't care about quality, we care about momentum, we're going to see a quarter like this where the higher quality managers underperform and the index fund is up 12%. From an international equity standpoint, two strategies here. The Fidelity International Index Fund, you'll recall we eliminated the Oakmark portfolio earlier in the year and consolidated those assets into the index fund. That was up 11.7%, right in line. So, great, second place contributor to the overall portfolio. Vanguard Emerging Markets up 9.5 versus benchmark up 12. A little bit of an underweight to some of the biggest names in the index like Taiwan Semiconductor and Samsung. But all in all, good start for them from a performance standpoint. Baird, right in line, no surprises. This is not quite a de minimis allocation, but is getting to be smaller and smaller as we build out the alternative investment portfolio. It's 9.6% of the portfolio as of the end of June. The two new additions, you'll see Bloomfield Capital and Capital Dynamics. So recall, Bloomfield Capital is making loans backed by real estate, kind of targeting high single digit, maybe flirting with low double digit returns. 6 months in, most of the money is invested in Series C. Up 4 and change versus benchmark up 3.4. More importantly, one of the beauties of that portfolio is they pay a 7.5% dividend each year on a quarterly basis. And we've already seen that kick in. So, the beauty of investing in private debt is, right, the return stream is generated by interest on the underlying loans. So money goes to work in Q1, as it's loaned out, what do you have to make? You get a month, and you have to start making your first payment, and that first payment is principal and interest, or in the case of real estate loans, usually interest only. We're already seeing distributions from that at that 7.5% coupon. So it's doing exactly what they said they would do, even a little bit better. So great start right out of the gate. Final piece, I feel like maybe we should talk about Clarkston and then end with this, but I said let's talk about Clarkston last. The capital dynamics. So, secondaries private equity portfolio, as I had mentioned at the last meeting, we were showing zeros for that as of December 31st, just because of a timing of that statement issuance. So we now have, December 31st pricing in. So that portfolio started in October with the first capital call. It's up 28% right out of the gate. So just the advantage of buying private equity funds at a discount to their most recent value, that's the entire premise of that secondaries market. So it's nice to see that right out of the gate do not only exactly what expected it to do in terms of a positive return, but kind of an outsized return. Managing expectations, right? I said, don't be as happy as you could be. Expect that number to come down over time. That's just a function of, right, if I can buy something that was worth $100 for $72, that gap is going to narrow a little bit over time. So I said we'd end with it, but Clarkston. Clarkston had another difficult quarter after a decent first quarter, but a very, very difficult calendar year 2024. So as I'd mentioned, kind of in the Reinhardt scenario, 2 to 3% of that underperformance can be attributed to names they didn't own, and frankly, given their process, should not have owned, right? But okay, that 2 to 3%, and I'll be generous just to make this math easy. Let's say it's 3%. So now they're only 9% behind the benchmark for the quarter, and that's really driven by a handful of names in the portfolio that they owned that frankly just didn't do well. We have been in, Michael, what do you want to call it? Active, spirited, healthy debate over next steps. We're having a conversation yesterday and the day before. Going to have more of a conversation today at some point around, where do we go from here and what do we do? This is a portfolio that our research team has spent a ton of time, or portfolio managers that our research team has spent a ton of time with. After calendar 24, spent a full day on site, kind of going through things, and came back, convicted. Planning that same trip here in the next couple of weeks, just given what happened in Q2. Q2 isn't a phone call. Q2 is an on-site visit to have another deeper conversation. From our standpoint, they are on watch, which means there's no new money going into the strategy. But this becomes kind of one of those tests of, am I as an investor? Right? It is a 22 stock portfolio that holds 1% to 20% in cash at times, based on not the market, but what's available versus their price target. If nothing's available, they're going to hold a little bit more cash. The issue with a 22 stock portfolio is, you have 5% in each name, 4% in each name. And if you get 2 of them wrong, you're 10% behind the index immediately, right? Or 5% behind the index, right? So it can stack up quickly. We haven't lost money on Clarkston. I think there's an important distinction. I'm going back to, I didn't make as much as I could, right? I'm happy, but I'm not as happy as I could be, because that overall experience dating back to 2018, now 7 years in, a little over 5% gain annualized. So that's 5% a year for 7 years. But the benchmark for that same time period's up 7.6. So I can tell you we've been having conversations with clients, obviously, that have this exposure. And I'd say it's probably been a 1/3, 1/3, 1/3 mix. A third of them have said, I'm out. I can't stomach the volatility. I can't take this. That has really been investors that have been in there for kind of 5 years and less, because they didn't get some of the earlier years of kind of banner performance and built up not only a margin of outperformance, but a margin of confidence of, I've seen you do really, really well. Our experience here would have been in 22. Markets are down 20 and they're up 1. So a third have said, doesn't matter, I'm out. I can't stomach the volatility. I need a more diversified portfolio. I need something that looks not like the index, but somewhat like the index, just so that I know from one quarter to the next, I'm not gonna have these wild swings. A third have said, I'm gonna give it a quarter or maybe two. And a third have said, I'm not gonna add to it, but like, I'll continue to hold. In the interest of full disclosure, kind of, and I feel like, Chris, this is gonna be your next question, is what was July like? They're about 2% behind in July. So it isn't like, ooh, hey, in the last, and I always hate this. We've laughed about this for all the years we've worked with, is, I can remember it was a small cap growth manager in 2009. It was like, we're 12% ahead of the benchmark since March 11th. And I'm like, that was like the last 32 days. Like, year to date, you're still 10% behind the index. So I'm always cautious around, like, I can't hammer a manager for trying to put spin on recent performance. But hey, if there's some glimmer of hope. So I'll pause there and take questions, but just know, like, it's not an easy decision in terms of where to go and what to do, given the quality of team and their background, but they're 13% behind.
So I'll throw it to the committee here, but, as Brett and I have talked about, if we pull the money from this is a mutual fund, so we can very easily transfer the funds. We could put it into the index fund, or we could put it into another manager, or we could leave it where it's at. So I'll let you guys ask questions and chime in and see where you want to take it.
Well, thank you. I understand we've been talking about Clarkston, just like Oakmark, for a while. Obviously, I was not a fan because we were missing the mark. And again, as you always talk about, step back. Let's look at 3 years, 5 years, since inception. We've been missing it each time. Mm-hmm. And again, I don't want to hold them accountable for 1 or 2 bad years, but again, we've missed and not kept up with the benchmark. I do like that we already have a few indexes in this kind of space. So adding to the index is one scenario, but I would rather then go to another actively managed portfolio to get that other piece, right? So like when we talk about diversification, we get some aspect of just index, very predictable. We're not worried about ups and downs. We're going with whatever the market, but then giving some other side to some of these high quality managers. It just happens to be that maybe this one is not where we expect and just hasn't been able to meet expectations. So that's where I'd want to go, is a new vetted manager that seems to have a better track record than Clarkston.
Jason?
I agree. I think, looking at these numbers, since inception in 5 year, I think we've been pretty patient.
So I won't call it, it's a conversation, right? And a healthy one. Mm-hmm. It's been a fun one. Is looking at options that complement Reinhardt and the Fidelity Extended Market Index Fund. And that's really where we're kind of diving in. So it's not someone that outperforms at the same time, because if we do that, we'll just add more to Reinhardt or add more to the index fund. There's no benefit of diversification. But it's looking through, the curse from traditionally, and this is something we see a lot in the retail world, is, right, I pull out Lippers, I pull out Morningstar, and give me the 5-star 135. I hired that one right at the top. They underperform for 2 or 3 years. I fire them. I go back to Lippers, give me the top 135. I hire that one. And you just perpetuate that cycle of hiring managers at the top of their performance cycle, because it's the old joke, right? There's 2 certainties in life, death and taxes, until you work in the investment community, and then you add short-term underperformance. So part of the conversation is around strategies around, like, hey, here's a manager with a great long-term track record, but it's stumbled in the last year or 2 years or 3 years. The idea being is we want to try and add that portfolio, not always at the bottom of the cycle from a performance standpoint, but trying to not just top tick every single strategy. We've done that. Like, that was the Reinhardt ad last year, as they had a difficult 23. Had a great start, stumbled a little bit, but understand why here in the second quarter. So that's what we're working towards. But in the interim, we can always move it to an index fund. What we never want to do is force a hiring decision. Unless there's some like, hey, this is a great strategy and they're closing at a specific time and we need to make a decision now. But when you have an index fund at 3 basis points that's liquid on a daily basis, that's 100% transparent, that I can be out of today, it's kind of a hard argument to not park it there.
Right. So the benefit in this portfolio is that we're holding Clarkston through a mutual fund.
Correct.
So I could sell that today and move it into the index fund and be done with it.
Yep.
And it sounds like that's the consensus, am I hearing?
Do you agree?
I agree, yes.
Okay.
Yeah.
Yeah, I think put the money there, let it manage until we can find somebody
Yeah.
who fits complement, as well as we get a good dollar average associated with what the value is of that.
Right. So I asked Brian to provide a couple of suggestions.
Yep.
2 are actively managed, separate accounts, and then 1 is a mutual fund. And I don't know if you want to, we don't really have too much time left.
All of them would
But-
still be available via mutual fund as well.
Okay.
Yep.
Because,
So-
I mean, the only concern that I have is that, you know, our Clarkston allocation right now is about 2.2 million. I don't know that a separately managed account, you know, a manager's going to get excited about that, unless we pair it with whatever we do with the pension plan. But I don't want to put the cart before the horse until we have the conversation about the pension plan in the next meeting. So that's an option, but, so, 1 is going with Ancora's other strategy. So we have Ancora for their dividend value strategy. Brian is suggesting that they have a SMID strategy, different team, right?
Completely different team.
Completely different team that manages the dividend value fund. Are they local? Is Dan Thalen local?
Yeah, Dan,
Okay.
I hate to use the word Clarkston. Dan lives in Clarkston. Dan Thalen is the guy.
Right, so he's local. Okay, so
And
that
they're
could be
at
good.
Woodward and Long Lake.
Right, so that
I'm
could be
sorry,
good.
they're in the city of Bloomfield Hills. They're not in the township.
No one's perfect. So, and then you also suggested Siegel Bryant as a separately managed account, and then Eaton Vance's Atlanta Capital, which would be done as a mutual fund. And they all work well, correlate well with Reinhardt,
Correct.
since we're keeping Reinhardt. So, why don't we, I'll move the funds from Clarkston into the extended market index fund, and then I'll be in touch with everybody about next steps on finding another active manager for the small mid-cap space. Otherwise, as Brian said, Bloomfield Capital has been paying us the 7.5% dividend. So that's been going straight into our cash account. We are a little over 50% funded on the Capital Dynamics commitment. There's still a little shy of 1.5 million that has not yet been called. So that cash is sitting in other parts of the portfolio. So we'll pull from that whenever we get capital calls. Brian, do you expect them to fully call this year?
They'll probably get to 75%.
This year?
Yeah, just
Okay.
given all the deal flow we're seeing and capital fundraising in primaries, like new money going to work, has drastically slowed. So we're seeing just an explosion of volume of secondary transactions from general partners, so private equity fund managers that have existing investors that are like, hey, we're like 12 years in, I want out. And Capital Dynamics is like, well, we're happy to provide the capital for you to tell your investors that you can get them out, but it's going to be at a 20 to 30% discount to what you currently think it's worth, because we're going to need to own this for the next 10 years. So that'll be, I think, a
Right.
continued driver.
Okay. Okay, so that's where we stand on that. I want to move on to Item 6 on the agenda, custodian update. So, as you guys know, we hired PNC Bank as our new custodian for not only the retiree healthcare trust, but also the pension plan and our operating reserves. We made that transition over at the end of June, beginning of July. I think it went pretty smoothly. And so far, I've been pleased with their service, and their technology is just far and away better than Fifth Third's was. So I think that process has gone well. And
Michael, if I may.
Oh, please.
Just, I think one piece to add to that is I know like the conversation at the meeting was US Bank.
Yes.
There were some concerns from the township standpoint around cash reserves and having a physical, branch in the community or near the community. So with that concern, Michael and I went back to PNC and we're like last, best, and final, and they beat what we had from US Bank. So I know the initial conversation was US Bank as the lowest bidder, and what ended up as a result of negotiations and conversations with legal counsel was PNC as the lowest cost provider for services.
Right. And also because, so Brian's right, that because US Bank, I couldn't get our legal comfortable with their physical presence in the state. And Act 20 requires the custodian to have a physical branch in the state. We had to pivot, and as Brian said, we went back to PNC, got them to beat the offer from US Bank, and PNC has lots of branches, so, and also offices, and so that's gone really well. The last thing, now number 7, new investments. So we don't really have available allocation for anything in real estate or alternatives in this fund. So we're not looking at anything at this point. Are there any other things that we should be thinking about in terms of new investments here?
Not for retiree healthcare.
Yeah.
Just where we are from an allocation standpoint. I mean, this is expected to grow significantly over the years, so
Yeah.
it'll be a conversation in the years ahead. I'm not going to say quarters ahead, just going back to that tempering expectations. But with that comment of nothing on the horizon, please note that that doesn't mean we aren't evaluating on an ongoing basis of if there's an opportunity to trade up for a higher quality. There's a unique strategy that we think would be a good fit to add to it. Those are still going to be conversations we're gonna bring forth.
Right. And do you think that we should be looking at any other active managers in the large cap space?
So we've eliminated Edgewood.
Right.
In the old, don't buy something and then go back and look at the price, 3 months later. I guess that doesn't work in today's inflationary environment, but they had a great quarter. They're up 15%, but benchmark was up 18. So it's not that we wouldn't be having the same be happy, but not maybe as happy as you could be conversation. Large growth just continues to be a really tough space. Just given the concentration of the index providers have put a couple measures in place to reduce that concentration, but it's taken it from being very, very concentrated to now just being very concentrated versus the S&P just being a concentrated index, given, Apple, NVIDIA, all of the big names from an
Right.
AI standpoint.
Right. So leaving it in the S&P 500 index, you think is the
Yes.
safest way to do it?
Mhm.
Okay. Any other thoughts or comments from the committee?
Not this time.
No. Okay, then I'll look for a motion to adjourn.
So moved.
Second.
We are adjourned.